It's 7:55 a.m. Eastern on Wednesday, February 11th, 2026, and I need you to understand what just happened while most of America was asleep, because this is not normal price action. If you went to bed last night thinking silver was finished because it closed ugly at $80.59, if you watched that capitulation candle and assumed the rally was dead, you woke up in a different market. London just printed a full-scale overnight gap that has every short seller staring at their risk dashboard like it has on fire. We hit 86.31 in overnight trade. Right now in pre-market, we're pulling back slightly around $85.40. That means we're still up almost $5 from the New York close, and the important detail is not the number itself. It's the way we got here. Yesterday's close had all the visual markers of a flush out. Heavy sell pressure, fear in the tape, that slow grind lower that makes retail traders question everything they believed 5 days ago. It looked like a distribution. It looked like the kind of day that shakes loose physical holders because they can handle the emotional whiplash. And that's exactly why this matters. When a market closes like that, most people mentally surrender. They accept the narrative, they tell themselves they'll buy later when it's safe. Then the overnight session opens and the market does the opposite, because the real battle isn't fought during the hours when headlines are being written. It's fought when liquidity is thinner and the biggest players can move size without giving you time to react. Here's the structure you have to internalize. New York closing does not end the silver market. It hands the baton to after-hours electronic trading. Then Asia starts to take volume, and then around 3 a.m. Eastern London comes online. London is where physical weight matters more than paper storytelling. London is where the biggest entities operate in a way that's tied to actual metal, actual bars, actual settlement realities. And last night, someone with deep pockets stepped in as if the $80 handle was a gift. The move started like a probe. It tested resistance levels that had projected prices all week. Then something broke. Stop snapped, forced repositioning kicked in, and the price ripped from $81.59 close to $86.31 in a couple of hours. That kind of move is not a cute little volatility spike. In a functioning liquid commodity market, you do not get a 7% surge in the middle of the night on nothing. You get that when the market is stressed, when positioning is crowded, and when the paper price is no longer the price that clears real demand. The spread between what New York printed and what London paid is the definition of dislocation. It's the market telling you the pricing mechanism is unstable, and when the mechanism becomes unstable, gaps become the new language. Now, before we talk about what happens at the New York Open, I want to frame the real question. This gap isn't just a chart pattern, it's a stress test. It's the sound of short exposure meeting a market that suddenly refuses to offer polite exits. The next step is where it gets violent, because the Open isn't just buyers and sellers meeting. It's margin calls, hedges, risk limits, and forced decisions. And the moment New York wakes up, the paper side is going to try to prove that last night didn't matter. The only problem is the chart already recorded the truth. To understand why that overnight gap is so dangerous for anyone on the wrong side of this trade, you have to understand what a gap actually does mechanically. When silver closed in New York at 80.59 and then effectively reopened in London above 81 with no trading in between, that empty space on the chart became a pressure chamber. By the time price accelerated toward 86.31, anyone who was short into the close wasn't just down a little, they were structurally trapped. A standard COMEX silver futures contract represents 5,000 ounces. If you sold yesterday at 80.59 and the price is now sitting around 85.40, that's roughly a 481 move against you. Multiply that by 5,000 ounces, and you're staring at a $24,050 loss per contract. That's not theoretical, that's marked to the market. If you were running 10 contracts, that's nearly $250,000 in overnight damage before breakfast. And that loss isn't optional. The clearinghouse doesn't care about your opinion on fundamentals. They care about collateral. If the account equity drops below maintenance margin, the broker issues a call. Post cash, or the position gets liquidated at the market. Now imagine thousands of contracts in that position. Some of those shorts are hedgers, some are speculators, some are algorithmic strategies that were calibrated for a grind lower, not a $5 gap in 2 hours. When price gaps like this, it bypasses normal exit points. There's no orderly unwind. There's just slippage and stress. And when margin calls start stacking up, the only way to stop the bleeding is to buy back the contracts. That buy to cover order becomes fuel. Covering pushes price higher, which triggers more margin pressure on the next short, which forces more buying. That's how a gap evolves into a squeeze. Technicians will tell you gaps like to fill. They'll say price tends to retrace into that empty zone between 80.59 and the low 81s before resuming any trend. And in many markets, that's true. But not all gaps are created equal. A low-volume headline gap is fragile. A gap driven by aggressive, sustained overnight demand in the physical heavy London session is different. When buyers are willing to transact size above prior resistance, they're not thinking about filling a chart pattern. They're thinking about securing supply. Right now, pre-market holding above $85 tells you the overnight move wasn't instantly rejected. If this were purely speculative froth, you'd expect an immediate collapse back toward $82 as soon as electronic liquidity thickened. Instead, we're seeing consolidation near the highs. That suggests at least part of the move reflects real repositioning, not just a thin book spike. The critical battleground is about to open at 9:30 a.m. Eastern. The paper market will try to reassert control. If the shorts are going to defend, they need to hit the bid hard and early. They need to push price back under $85, ideally under $83, and create the appearance that London was an anomaly. If they can't, if every dip is absorbed and price starts probing $87 again, then the gap stops being a curiosity and starts becoming a launch pad. Because once a market proves it can gap through resistance while the dominant session sleeps, it sends a message. Supply is tighter than the chart suggests, and someone out there doesn't care about yesterday's close. Now step back from the intraday mechanics and look at the structural backdrop, because this overnight move didn't happen in a vacuum. It is sitting on top of a market that has been tightening for months beneath the surface while the paper price pretended everything was balanced. COMEX registered silver, the category actually available for delivery, has been hovering near multi-year lows. Depending on the latest warehouse report, we're talking tens of millions of ounces available against hundreds of millions of ounces in open interest. That's not unusual in a purely financialized system where most contracts are rolled or cash settled. But it becomes dangerous when confidence shifts, and a larger percentage of participants consider standing for delivery. If open interest represents claims on, say, 800 to 900 million ounces, and registered inventory sits near a fraction of that, you don't need everyone to demand metal. You just need a small shift in behavior. Even 10% of contract holders decide they want to physically change the equation dramatically. At that point, the exchange is forced to incentivize cash settlement, source metal aggressively, or tighten rules. None of those outcomes are calm. Overlay that with the global supply picture. Annual silver demand is running north of 1 billion ounces when you combine industrial usage, jewelry, coins, and bars. Supply from mining and recycling struggles to keep pace. The difference has been filled by drawing down above-ground stockpiles. That works for a while. It does not work indefinitely. Silver is not just a monetary hedge. It is embedded in solar panels, electric vehicles, electronics, medical devices, and grid infrastructure. Governments across the world have committed capital to green energy transitions that rely on silver-intensive technologies. That demand is not discretionary in the short term. Factories don't pause production because futures charts look extended. They secure material. Now add geopolitical pressure. Since the 2024 shift toward alternative trade settlement mechanisms among BRICS nations, physical metal flows have increasingly reflected strategic accumulation. Central banks have been net buyers of gold at record or near record levels for multiple consecutive years. Silver tends to follow gold's monetary re-rating, but with greater volatility because the market is smaller and more fragmented. Meanwhile, the U.S. fiscal picture remains strained. Persistent deficits north of $2 trillion annually and a debt-to-GDP ratio well above 100% create a long-term incentive to tolerate currency debasement rather than pursue aggressive austerity. When bond yields rise and foreign buyers reduce Treasury exposure, the Federal Reserve faces a narrowing path. Either allow rates to climb and stress the system, or intervene and expand liquidity. Every time liquidity expands to stabilize one corner of the system, hard assets tend to benefit. That's not ideology, it's historical pattern recognition. So when you see a 571 overnight gap in silver, you shouldn't isolate it as a random technical anomaly. You should ask whether it trusts an early symptom of capital reallocating ahead of stress elsewhere, whether in the Treasury market, the banking system, or global trade flows. Because if physical buyers are accelerating accumulation while paper shorts are still leaning on the tape, the imbalance doesn't resolve quietly. It resolves through volatility. And volatility in a tight, leveraged market is rarely polite. Now bring this back to the immediate battlefield. The short sellers who went home comfortably at 80 per 59 and woke up staring at 85 plus on their screens. That overnight gap is not just a chart feature. It is a balance sheet event. On a standard COMEX silver futures contract, one contract represents 5,000 ounces. A $5 move against you is $25,000 per contract. If a trader was running 10 contracts short into the New York close, that's roughly a $250,000 swing in a matter of hours. And that's before volatility adjustments, before intraday margin increases, before slippage on forced execution. In leveraged markets, losses are not theoretical. They are collateral calls. When the market opens in New York, brokers reassess exposure. If price remains elevated, short positions require additional margin. If that collateral isn't posted immediately, positions get reduced or closed automatically. That means buying futures at market prices to exit short exposure. And buying from shorts is upward pressure. This is how a gap transforms into a squeeze. The first hour after 9:30 a.m., Eastern Open becomes critical. Institutions that are short will try to defend key levels around numbers like $85, $87, $90. They may attempt to flood the market with sell orders to push price back toward the gap zone around 82 to 83. The goal isn't necessarily to collapse the trend permanently. It's to stabilize books, reduce panic, and avoid a cascade. But here's the vulnerability. Liquidity is not infinite. In recent years, much of the suppression in commodity rallies has been enabled by ample short-term funding through repo facilities and deep derivatives markets. Banks and funds could absorb temporary mark-to-market losses because they had access to cheap capital and predictable flows. In a tightening liquidity environment, that cushion shrinks. If yields in the Treasury market are rising and funding costs increase, maintaining large synthetic short positions becomes more expensive. The margin to suppress volatility narrows. At the same time, if physical buyers are removing metal from circulation through delivery, vault transfers, or long-term storage, the paper market becomes increasingly disconnected from available supply. That's when reflexivity takes over. A move above the overnight high, above 80.31, would not just be technical, it would signal that attempts to cap the rally failed, that failure forces weaker shorts to capitulate. Capitulation begets higher prices. Higher prices trigger additional margin calls. The cycle feeds itself. On the other hand, if the New York session aggressively fills the gap and pushes silver back into the $82 or $83 region, it signals that paper supply still dominates short-term pricing. That doesn't negate the macro thesis, but it delays the squeeze and resets positioning. This is why discipline matters more than prediction. Volatility of this magnitude is an opportunity and a risk simultaneously. Traders chasing momentum without defined exits can get trapped in sharp reversals. Shorts stubbornly anchored to prior prices can face exponential losses. The only consistent winners in environments like this are those who understand structure, inventory levels, open interest, funding conditions, and cross-market stress. Because what we're watching is not just a metal ticking higher, it's a test of control between physical demand and synthetic supply, between balance sheet constraints and leverage, between short-term defense and long-term repricing. And those tests rarely end quietly. Step back from the noise of the candles and look at what this moment actually represents. An overnight 571 gap in a globally traded industrial metal is not normal price discovery. It is a stress signal. It is the market flashing a warning that something underneath the surface is tightening. Silver closed at $80.59 in New York. Within hours, London traders were willing to transact above $86. That is not retail enthusiasm. That is not social media hype. That is size. That is balance sheet money. And when balance sheet money moves in the physical session, it usually means allocation decisions have already been made at a much higher strategic level. Now the focus shifts to sustainability. Can the paper market reassert control? Historically, it has. Margin hikes, coordinated selling, narrative management. These tools have capped rallies before. If volatility expands too quickly, exchanges can raise collateral requirements, forcing leveraged longs to reduce exposure. That creates selling pressure and can temporarily restore order. But there is a structural difference in 2026 that didn't exist in prior cycles. Persistent supply deficit combined with geopolitical fragmentation. Annual global demand is exceeding mine supply by hundreds of millions of ounces. That gap is being filled by above-ground stockpiles, and those stockpiles are finite. At the same time, trade settlement systems outside the dollar framework are slowly gaining traction. Central banks continue accumulating gold, and silver tends to follow gold when monetary confidence erodes. Add in Treasury market stress, elevated yields, and a Federal Reserve balance sheet that remains historically large, and you have a macro backdrop that favors hard assets over long-duration financial claims. None of that guarantees a straight line higher. Markets breathe, they surge, they retrace, they test conviction. The gap could partially fill. Volatility could shake out weak hands. A sharp intraday reversal would not invalidate the larger thesis. It would simply reset positioning. The key variable to monitor is not just price, but behavior. Inventory withdrawals, delivery notices, dealer premiums, and cross-market funding stress. If COMEX registered inventories continue declining while price holds elevated levels, that is confirmation of physical tightness. If dealer premiums expand in retail markets, that indicates strain at the distribution level. If yields spike further and risk assets wobble, capital may rotate defensively into metals. The deeper question is this: what is silver repricing against? Is it inflation expectations? Is it sovereign debt sustainability? Is it geopolitical risk? Or is it simply the math of scarcity meeting leverage? In reality, it is likely a combination of all four. For investors holding physical metal, the framework is patience and risk tolerance. Physical ownership is not about intraday swings. It is about systemic insurance. For traders in derivatives, the framework is discipline. Define exposure, respect volatility, accept that squeezes can overshoot both up and down. What happened overnight was not random. It was a reaction within a complex global system under strain. Whether this becomes a full-scale squeeze or a violent consolidation phase depends on how participants respond at the open and in the sessions that follow. But one thing is clear. When a market begins moving this aggressively outside headline catalysts, the environment has changed. And environments like this don't reward complacency.